Hello and welcome to NAIFA Live, your monthly membership meeting. My name is Zach Hewells. We have a couple of great speakers here to talk about premium financing today, but first I would like to kick things off by turning things over to our NAIFA volunteer out in NAIFA, Tennessee, John D. Richardson, with the Pledge of Allegiance.
Please join me now for the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Well, thanks so much, John. And now I'm going to turn things over to NAIFA CEO Kevin Mayu for some NAIFA announcements.
Hello, NAIFA Nation. Welcome to June. Really glad you could join us here for NAIFA Live today, just on the heels of our incredibly successful congressional conference that we had in Washington, D.C. in late May. The event, for those of you that were able to attend, know it was absolutely impactful. For those of you that weren't able to be there, know that we had more than 500 advisors that went to Capitol Hill to carry our message to members of the U.S. Senate and to the staff members present from the U.S. House about important legislation they're considering, including the passage of the Secure 2.0 Act. Absolutely amazing activity with 162 first-time attendees at the NAIFA Congressional Conference. We're able to visit more than 80% of the Senate offices and bring that message to them. And knock on wood, we're going to make great progress seeing Secure 2.0 pass in the months ahead. I want to thank all of our sponsors that helped make our congressional conference an absolutely incredible success in May. More to come as NAIFA continues our great advocacy work on Capitol Hill and in our state capitals all around this country. I also want to thank those who participated in our 7th annual DEI symposium that was held right on the front end of the congressional conference. We had more than 90 people attend the DEI symposium, and that again reiterated NAIFA's leadership role in making sure that we have a diverse profession that can serve a diverse country and make sure that all Americans can be financially secure in their life. I want to thank our sponsors, Aflac, Emeritus, and Equitable, for helping make our DEI symposium an incredible success in Washington, D.C. last month. Also, last week, we held our Advanced Practice Symposium out in Scottsdale on June the 9th. We had more than 70 people register and attend that event in Scottsdale, an absolutely incredible production that we put on in collaboration with the Society of Financial Service Professionals, our partners in the Advanced Practice Center. I want to thank Victor Goldman of Goldbook Financial for his strong support of that activity and for bringing many of our attendees as well as prospective new members to that Advanced Practice Symposium in Scottsdale. Our next one coming up is this fall, and it's in Philadelphia. It's a great event, so I'd encourage you all to check it out at theapcenter.org. And our next major NAIFA event is coming up, and that is our re-envisioned sales symposium for today's advisor, which we have renamed and we are calling Apex. Apex will take place at the absolutely incredible Arizona Biltmore, August 17th through 18th in Phoenix. But since the conference is really those 2 full days of programming, I'd encourage people to go out there on the 16th or maybe even the 15th and really have fun and take in all that the Arizona Biltmore has to offer, and maybe even stay a day or two later. And again, take in that beautiful Frank Lloyd Wright architecture and everything that the Phoenix area has to offer. The conference itself, though, on the 17th and 18th is going to have some stellar speakers, motivational activities, and just a lot of fun for everybody who attends. Also, for those of you that are on this NAIFA Live presentation, we have a special gift for you, and that is a 20% off code if you'd like to use it and register for Apex prior to June 30th. And that code is NAIFA Loyal, all one word, NAIFA Loyal. Again, use it by June 30th for 20% off. The website is apex.naifa.org. Please check it out. And then today's NAIFA Live event is a real treat. We're going to have Anthony Martinelli and Bob Bagonis present on their insights related to premium financing. So let's give our attention to Anthony and Bob. Take it away.
Good afternoon, everyone. Thank you, NAIFA, for allowing us to present. My name is Robert Bagonis. I am founder and principal of Tritium Private Wealth Strategies. I'm also here with my partner, Anthony Martinelli from Jacoby. And today we'll be presenting on premium financing and applications for advisors within estate planning, business succession, deferred compensation, and other potential opportunities you may have for your clientele.
Thanks, Bob. Appreciate it. Good afternoon, everyone. We appreciate everyone taking some time this afternoon to hopefully learn about a topic that's that's pretty popular in the life insurance space and the financial advisory space. So hopefully we could give you some valuable information to take back to your respective practices and add value to your clients, prospects, and centers of influence. So my name's Anthony Martinelli. I'm co-founder of a firm called Jacoby Wealth Advisors, about 20 minutes outside of Center City, Philadelphia. I've been in the financial planning space for about 28 years. So for the last 15 years, I've spent most of my time working with high net worth clients, and generally ranging from the 10 million to $350 million net worth space. So I'm someone that's in the trenches every day and working with clients with strategies, implementing strategies, working with their advisors, their CPA, their attorney, to make sure that we're putting wealth protection strategies and financial planning strategies in place. So obviously the topic of our conversation is advanced applications of premium financed life insurance. So with that, and our contact information is also on the slide. But with that, I'll sort of get into sort of a basic primer on what is life insurance premium financing. Basically, it's when we talk about premium financing, it's not a specialized type of life insurance product. It's finding a third-party lender that is going to lend the client premium to fund life insurance contracts over multiple years. So typically these are the client entering into a lending arrangement with a bank, with a third-party lender. It's going to be a loan that will be taken annually, renewed annually, and typically a bank is going to fund contracts over anywhere from a 7 to 10 year period. And the client, rather than putting premiums into the policy, is actually going to be making an interest payment on a loan, just like they would on similar types of other loans. So it's important, and any bank, frankly, can lend to life insurance financing. But having said that, we work with a finite number of banks that have been in the space for a long period of time. They've been able to lend through multiple economic cycles, and they dedicate a significant amount of resources to their life insurance lending division. But again, it's not a specialized type of product that a carrier creates. Having said that, there are a finite number of carriers where their products do work very, very well if the client's goal is to finance life insurance. So when we talk about why consider premium financing for clients and prospects, there's a couple of reasons. I mean, obviously you have a client where you've identified they have a significant need for life insurance or a significant amount of life insurance on top of that. And it may possibly give them the opportunity to potentially spend, a good amount of dollars, significantly less dollars than they would potentially funding the life insurance by traditional means, meaning a 10 pay, a 15 pay, a 20 pay, a life pay, where they're going to put a considerable amount of premium in. They may be able to take advantage of, a low interest rate environment, the bank putting in significant dollars into the contract, thereby being able to shorten their time frame on how long they pay, and pay significantly less, for the life insurance that they need. And it also gives them the opportunity to retain their capital. So in the affluent marketplace, in the high net worth marketplace, generally capital is really important, where they want to reinvest dollars back into their business, or they're buying real estate, or they're investing in other business opportunities. So the ability to retain as much of their capital as possible certainly is something that's important to them. So if they have the ability to pay less and retain more capital, more of their own capital, that's something that's generally appealing to them. In terms of key applications for premium financing, I want to get into that more on the next slide, along with candidates that are a good fit for financing. But want to talk about a little bit about why premium financing can expand your client cross-selling capabilities and supercharge your prospecting. So in the high net worth marketplace, and even in the advisor marketplace, in many cases, I think there's a misnomer out there that I've found that, in the high net worth space, wealthy clients have all this planning executed, right? They have all their I's dotted and T's crossed. and they know all about premium financing, and I've found through experience that tends to be the opposite. And there's been very, very few high net worth prospects that I've approached or clients that I've approached that maybe had a premium financing program in place, and that's the method they were utilizing to purchase their life insurance. They just really haven't, or they really aren't familiar with it in many cases. So you're really giving them ideas and strategies on. Granted, they all typically may have life insurance, and some have term and some have permanent. Some are spending considerable dollars on permanent insurance. It's not an insignificant line item, in the high net worth marketplace, but they generally haven't heard of financing. And when you get into the advisor, it gives you, when you talk to their advisors or CPAs, or if you have centers of influence or strategic alliances like CPAs, it gives you an opportunity to have a different type of conversation, even certainly with the prospect, where you're discussing the ability for them to retain more of their capital and potentially improve the outcome, increase the internal rate of return on life insurance that they're buying. So sometimes advisors, I've run across situations where I have onboarded wealthy clients through premium financing, through estate planning arrangements, and the advisors in many cases, the CPA, it may be their wealthiest client, and they've grown with that client, and they have a relatively smaller client base. They don't have dozens of high net worth clients, and they in many cases they haven't heard of it either. So it's a value added conversation. It's an educational conversation that they typically take well to. So it gives you an opportunity again to sort of expand your cross selling capabilities. I'd like to talk about common mistakes made when selling premium financing, because there can be many common mistakes made. I mean, some of the things that I've seen typically is selling as a transaction. So if it's a situation where you're just trying to go out and sell premium financing and sell a large premium as just sort of a standalone strategy, that's generally where you run into trouble. I mean, I've never sold a premium financing case where it wasn't done in the context of planning, whether it be an estate plan, a business succession buy-sell strategy, charitable planning, deferred comp planning, those sorts of things. I mean, it's always identifying the need, disturbing the client that they have a planning issue, honing in on goals and objectives, and then developing a strategy where, okay, we've identified a need for life insurance, but another common mistake that's made is we want to be able to then present alternatives, right? So we want to be able to present, this is a traditional way to fund your life insurance needs compared to the opportunity to finance and utilize leverage. So it's being able to present them the alternatives, both on a traditional basis and on a finance basis, and that's important. So I think if it's a transactional sale, you're in trouble. If it's a sale that's in the context of planning, you build a ton of credibility, with the client, with their advisors, and the advisors have to be brought into the loop, because the client it's a significant financial arrangement transaction. So if you're trying to run into a situation where you try to not include advisors, or maybe sell the case and include the CPA on the back end, you can run into some trouble there. So I always make a point to bring the advisory team in up front. We need to talk to your CPA about this. We need to talk to your attorney about this, because usually we're dealing with trusts or a structure that needs to own the policy, and we make it a collaborative effort where we are educating the entire advisory team along with the client. Some other things that we've seen that are sort of red flags or common mistakes are not using an open architecture format. So maybe if you're focused on one insurance carrier that you place 90% of your business with, and then you're trying to use their product for financing, but it just may not be the right fit, the right product fit for the financing arrangement, you really need to expand and we believe have an open architecture format in terms of carriers that you're using across the industry, because they have the products may be nuanced a little bit differently, and they may have different strengths that play really well within financing arrangements. So, some of the other things that we see, we're big proponents of using whole life and using a significant portion of whole life in the design. I've worked with 4 or 5 of the major premium finance vendors in the country, and I've seen many that utilize 100% IUL driven designs, and we believe, if you run into a situation where you have extended periods of an extended bear market where you don't have performance, there's a variety of reasons where 100% design, IUL design, may present some problems down the line. We believe in sort of a combination and treating the insurance almost like an investment portfolio, where we'll have whole life, we will have IUL, but we'll design that portfolio to help achieve the objective and minimize risk to the clients. We want performance. We want to be able to perform through original projections, and a blend of products gives us an opportunity, to sort of hit that bar and perform over time and meet the client's expectations. And the other thing we see common is it's not a let's get the case closed, let's get the case into underwriting, let's take an application, right? Those when I've typically sold premium financing cases, right, and have closed probably over 50 of these over the last 15 years, it's never I want to take an app. It's when the case goes to underwriting, generally that case is 95% closed. We've gone through all the planning strategy. We've gone through traditional funding versus financing, and it's not a situation where we're sort of trying to rush that case into underwriting, because the cases do take significant time, to close. It's not something that happens in 3 months. I mean, the lifespan of these cases in many cases is 6 to 12 months typically before you're implementing the strategy. So I'll move on to what situations are a good fit for premium financing. If you look at applicable situations, it's the estate planning marketplace is still the primary marketplace, right? So with higher exemptions, where we have close to $23 million of exemptions, estate taxes impacted less people over the last several years. However, with sunset provisions coming into play over the next few years, in all likelihood, exemptions probably will decrease eventually, and you're going to have more individuals impacted by the estate tax. But having said that, wealthy individuals, high net worth individuals have really supercharged their wealth the last several years. I mean, even through COVID. So you do have significant numbers of families that are impacted by estate tax. So I'll normally say financing candidates with estate value north of $10 million. That can include, closely held business value, real estate values, traditional stocks and bonds, alternative assets. All of those things contribute to the balance sheet. But here, premium financing serves multiple purposes, including liquidity for estate taxes, the ability for the family to create an alternative asset class, sometimes estate equalization with family-owned businesses where there may be children in the business, children that are not part of the business have opted to select another career path, and we can equalize inactive children with life insurance assets, income replacement, educational funding, debt payment, all the traditional needs for life insurance, and giving that family the ability to avoid liquidating assets or creating a fire sale because they don't have enough liquidity, to pay the tax. So estate planning is still typically at the forefront in terms of premium financing and using that to fund life insurance. But we also see families with significant non-retirement portfolio value with family trusts, right? So you have a lot of family trust wealth out there where there's a good amount of traditional stocks and bonds and investments sitting inside a family trust. We're doing a lot of intergenerational split dollar planning, utilizing premium financing, the ability to have that cash value build up and mitigate tax on cash value build up, as opposed to trust income that's taxed at the highest rate at a pretty quick income level. So those life insurance cash values can be another alternative asset class within that trust that not only provide death benefit, but also tax efficiency. When we go to the business owner marketplace, you have insurance for funding for buy-sell agreements, right? So that's a huge marketplace where you have a business that has significant value, that has multiple partners. Those partners, have life insurance typically funding the buy-sell for the purpose of a buyout, upon the death of a premature partner. Financing those policies and being able to create a significant amount of cash value can serve. You not only have obviously the purpose of the death benefit with funding a buyout, but then you can also have a sinking fund to be able to provide future income, buyout proceeds to buy a partner out, a living buyout, or provide retirement income. So the buy-sell marketplace is really a great marketplace to look at premium financing. Again, if you have a really valuable business that's generating good cash flow where the partners need significant death benefit. We also identify sole owner problem running into this more and more with, especially in the baby boomer generation, where maybe the children didn't go into the business. They just have chosen other paths. And you have an owner that has a sole owner that has a really valuable company, but they don't have any direct successors. So there's no family in the business. However, they may have, a management team. They may have a group of key employees that have been there a long, long time that are more than capable of running that business. But the owner has an issue where if the owner were to die prematurely, right, they can't, to preserve the value of that business and not facilitate a fire sale. We want to be able to put a succession plan in place, and that life insurance can serve a very valuable planning purpose to be able to help lock in the value of that company. In some cases, even be able to provide a management buyout, or whether it could be an ESOP, something along those lines, where we're also able to help facilitate the transition in that business and preserve the value for the family and for the families, for the owner's estate. Professional service firms are also a great marketplace. So when you look at even financial advisory firms, private equity firms, hedge funds, law firms, medical practices, architectural engineering firms, they have typically an issue with succession planning where they may have older partners, they have buyout obligations, down the line in the future. They may have an older group of partners and a younger group of partners, and they have this obligation that they're facing maybe in the near term or in the long term. And they also have, shareholder agreements with buyouts that are required. So they have a need for life insurance. And again, that life insurance, we've worked cases where we had, law firms that had a succession planning issue. We were able to actually overinsure, younger partners in the firm, which increased internal rate of return and provided a great sinking fund to be able to buy out, partners in the near term and into the future. So we're able to use that strategy, that financing strategy with the advantages of the life insurance to be able to facilitate succession plans and buyouts in professional service firms. The executive comp space, the non-qualified plan space, we're finding is a huge space right now, especially with the labor market being so tight. Almost every client that we have is a business owner, and they're all in a fierce battle to retain and recruit talent to their companies right now with the labor market being so tight. So it's, in health benefits and 401k and a good salary and bonus, that's to be expected today. So deferred comp plans, supplemental executive retirement plans, the non-qualified plan space right now is really huge because there's another layer of benefits that are differentiators that we can include. And when you look at the SERP or the non-qualified marketplace, you always sort of get into that life insurance discussion on, okay, here's how we informally fund your program, right? Traditional investments versus the advantages of life insurance. And then we get into, again, funding life insurance the traditional way, and then funding life insurance using leveraged and financing that coverage and what that can do to the internal rate of return of the program. So that's a great marketplace. High income earners also a great marketplace. So you have individuals potentially that are making $750,000, $1 million a year. They've maxed out retirement plans, or they may be limited from a plan design perspective on how much they could put into a retirement plan. That could be maybe not the affluent space yet. I mean, you may have a 40-year-old that you don't consider high net worth because they're in the process of building their net worth, but they have great cash flow, and they're building asset classes, and they have the ability to put significant dollars away. You can look to the financing market space, and when you look at life insurance as an alternative asset class, it gives them the ability to grow a significant amount of potential future tax-free retirement income and finance cash-rich life insurance policies. The charitable planning space is also huge. I mean, we're big proponents of what we always refer to as the zero tax estate plan. So how to really help the client mitigate or eliminate estate taxes while also benefiting causes and charities and foundations that they may want to create, be it a variety of charitable trusts or their own private foundations. Finance life insurance is a fantastic way to show the client that they can pass assets on to the families, to their heirs, and also be able to benefit charities and causes that are near and dear to their heart. So that's a great application, and that typically can be intertwined within the client's estate plan as well. So if I look at financing guidelines, we move on to financing guidelines, premium financing, no-nos, mistakes, red flags. I covered a little bit about this, but just a couple of things I think that are really important. I mean, premium financing, it's not free insurance, right? It's not stranger-owned life insurance. It's the client is going to enter into a significant financial commitment, and there's significant administrative burdens that are placed on the financial advisor as well. And we partner with advisors all over the country. We have a sort of a turnkey process to help them support their relationships, but there definitely is administrative requirements and a significant transaction that the client enters into. And typically the client is going to have what we refer to as skin in the game. So they're going to pay loan interest. We don't enter into arrangements where they're rolling up loan interest into the loan. So they're paying loan interest on a year in, year out basis. They're posting unencumbered liquidity for collateral. I mean, that could be securities, that could be a cash or a CD, it could be a letter of credit, but they're posting collateral. And I know Bob will cover gap collateral a little bit in his presentation, but they also, understand the risks of using leverage in the transaction versus not using leverage. We also, say it should not be sold as an alternative because the client can't afford traditional insurance. So the clients finance because they have the ability to, not necessarily because they have to. Again, I covered that earlier. So the client has the opportunity to retain capital, invest savings and cash flow in other projects, investments, their businesses, but it's not because they can't afford premiums. And one of the underwriting factors with a bank or with a carrier is does the client have the financial wherewithal to afford those premiums and fund those premiums if the financing arrangement wasn't part of the scenario. That's really important, and stress testing is really important. So it's not a replacement for traditional unlevered savings and investment strategies. I've referred to alternative asset class, and it can be an alternative asset class, but it's not there to replace traditional stocks and bonds. Again, it's in the context of a plan. It becomes another asset class, but it's not there to replace other asset classes. So it should be prioritized and positioned as life insurance, with the potential to generate income. But we always tell the client, look, don't put all your eggs in one basket. And as far as carrier guidelines, there's been a number of carriers have revised their guidelines, right? Because especially over the last several years with rates being so low, I mean, carriers have onboarded, significant amounts of premium via financing arrangements. So many of the carriers sort of looked at, they have reserve requirements, and some carriers have gone to, $15 million of net worth. Others have gone to 10. Most carriers are going to want at least, $7 million of total net worth. We say 5 to 15 million here, 5 at the very low end. But again, they're going to look at, can the client afford the premium without lending? They're going to look at stress testing. So, they require us to stress test the design to make sure that underperformance does the strategy work. That's really important. The bank wants to see that as well. And as an advisor, you're also going to have, generally speaking, you're going to have probably a little bit of increase in E&O coverage, and the carrier is going to require you to go through some specialized training modules, I should say, that you'll need to take. On the lender guideline situation, it's again typically the same 5 million to 15 million. Most loans that we do are typically, $1 million. It's usually $1 million loan minimum. We do have some specialized programs where some of our banks will go down to $500,000, and we still get private bank rates, but they usually want a net worth of 5 million to 15 million. And they're looking at debt to income ratio. So they're underwriting this loan. You're submitting, tax returns and business documents if it's for business purposes. So there's a whole host of financial information they would gather, just as if you were applying for any other type of loan, a real estate loan, a home loan, etc. And they're also looking at stress testing. And, the advisor, we have to provide annual financial document gathering. So, we're usually updating the personal financial statements, submitting updated tax returns, because these loans are being, renewed on an annual basis. And it's typically a 7 to 10 year commitment from the bank, and the client is entering into that arrangement knowing that it's a long-term arrangement. So there's that annual administrative burden. We help try to ease some of that burden with advisors that we work with, but nonetheless, it's there and something you have to be cognizant of. So I'm going to that's pretty much what I wanted to cover at this point. I mean, hopefully been able to provide, some good information, some good background information. I'm going to turn it over to Bob Bagonis at Tritium. Bob's going to cover, building a plan, setting client expectations, and I know review a case study and actual sample design for all of you to take a look at. But really appreciate your time this afternoon, and I'll turn it over to Bob.
Thank you, Anthony. Again, I'm Bob Bagonis from Tritium Private Wealth Strategies. We're based outside of Philadelphia, and on many things that we help advisors with, who are mostly our clients. Premium financing is one of our most popular offerings. We are an approved premium financing intermediary with the major insurance carriers and lenders. And when we're working with an advisor, you want to start off not only educating the advisor, but also the client as well. This is a project, right? We're building a building here, right? So you need design plans. You have to bring in an architect, the engineer, and then the contractors. So when you're working through the process, it's not as simple as just, an application for an insurance policy, filling out a credit application. There's a lot that goes in to the process. And if you're going to have a successful plan and sound plan, you want to make sure that you're dotting all the I's, crossing all the T's. From a high level, when we look at it, there's three primary routes that we're pursuing simultaneously in order to accomplish a well-rounded premium financing plan, whether it's for estate planning, buy, sell, deferred compensation. Obviously, it's life insurance. So we want to make sure that we're justifying the need for insurance. So if we're working with high net worth clients, regardless, you're going to buy a sizable insurance policy. You want to make sure that the clients can gain the coverage on their own, right? So if it's for estate planning, we're looking at their net worth. What is their estate tax? Let's project that out at a conservative growth rate, determine what their estate tax need is, minus their exemptions, take their other planning into account. Do they have other insurance? And generally, you're going to look for clients 65 years of age and younger. Can you do clients that are slightly older? Yes, generally the carriers are going to start pushing back. And obviously the cost of insurance, whether it's finance or not, is extremely expensive over and above age 65, making financing maybe not the best option for clients that are older, unhealthier. So you're looking for standard to preferred to elite offers on clients 65 years of age and younger. On the banking, this is similar to a mortgage. So you're looking at personal financial statements, last 2 years of tax returns, liquidity statements for their accounts. And you also want to make sure that they have a clean bill of health financially, right? So oftentimes we'll get to the 11th hour, right? We're at the 1 yard line with the client. We find out he has a tax lien. And even if that tax lien might be $2,500, it is a pain to have the client, go through that. He might have not known about it. You have to clean that up, have the lien removed, whether it's federal, state, or local, or something like that. So you're looking for a clean bill of health financially in terms of credit scores, tax liens, any obligations that may have not been disclosed up front. And one of the biggest conversations that we'll get into is collateral. How is the client going to post collateral? There's many different forms. Cash is one form, pledging a securities account, a non-qualified securities account. In the case where that's not possible, perhaps getting a letter of credit from the client's own personal bank or local bank or regional bank would be used against other assets, whether that is, cash, a revolving balance for his business relationship with his own bank, et cetera. In terms of ownership and structure, this is where oftentimes this is going to be the most time consuming. How is the policy owned? With a sizable insurance policy, especially for estate planning, you don't want to artificially inflate the balance sheet of the client at death by having the death benefit or proceeds from life insurance enter into the estate. So typically it's going to be owned by an irrevocable life insurance trust or other entity owned outside of the client's estate. Who is the trustee? Do they have a qualified attorney? And the attorney is going to have to be explained the transaction to make sure that the trust can borrow. The trustee has a fiduciary responsibility. So is that trustee competent in order to follow through on what's necessary to renew the insurance and the premium loans every year? And also, too, you need to keep in mind that when the client is paying interest, and often that happens, he'll make a payment directly to the lender. How are we booking that interest payment? If he's paying on behalf of the trust, you could either use annual lifetime gifts, or what's often done is to make a separate private loan to the trust that needs to be booked and recorded, make sure that's a bona fide loan in order to get repaid, make sure that we're accounting for interest appropriately. The benefit of doing that is that we can preserve the lifetime gift exemption of the client, and we can either forgive that separate private loan to the trust down the road. But again, that is something that needs to be accounted for every single year. Make sure that the client has an attorney or CPA that is on board, that you're working with on a consistent basis to make sure that's taken into account. Signatories. Sometimes people will have 3 different trustees. That's fine, but for wealthy clients, they have trustees and relationships all across the country. Trying to track down wet signatures for 3 trustees in 3 different states is a real pain. So when you're drafting that trust, you want to make sure that you can limit the trustees that have signature authority on issues regarding insurance and lending for the transaction. You also want to make sure that you're isolating the insurance and the premium loans to just one trust, or that is the only transactions or assets that need to be tied to that trust. You don't want to commingle, say, business interests or real estate with your premium finance loan. You kind of want that trust to be a separate entity. In the event of default, something goes wrong on either a business or real estate that could impact the trust assets, and vice versa. If you default on the premium finance loan, you don't want that dirtying up the client's trust-owned real estate or business or security interests. So that's kind of the project from a high level. This is how you start the architecture of the plan. Moving forward, the most common application of life insurance, obviously for high net worth clients, is going to be to supply liquidity for estate taxes. Typical case, if you're working with a client worth $50 million today, maybe the client has done some planning. In this case, this particular case study, clients had a very robust family limited partnership, family investments, retirement assets were minimal. Most of the assets they had were non-qualified liquid investments. They had some real estate and some other private business interests. Working with the client, you want to make sure that you're not operating in a vacuum, just bringing premium financing. You're partnering with often the client's gatekeepers, the attorney, the accountant, their CFO, CIO. And what we're doing is trying to roll in premium financing or an insurance-based solution. We want to look at all the options and make sure that it's going hand in hand with the planning they've done or proposed planning by the advisor that we're partnering with. In this case, if you were to take, say, $50 million of assets and let's grow that to the client's life expectancy, let's call it age 90, that estate would grow to roughly $250 million. Where we were at, they have not yet moved any of their, say, family limited partnership, business, real estate outside of their estate. So that would be fully taxable upon the second death, and they had no life insurance. If we were just to grow to the estate out to life expectancy, you're looking at approximately $100 million estate tax bill, right? So about 40 cents on the dollar over and above their lifetime gift exemptions. Working with the advisor, working with the attorney and accountant, what we were able to do is take transfers now and move some of their hard assets using lifetime gifts exemptions in a private sale to move that taxable appreciation over their lifetimes outside of their estate. So right away, before we just go in and sell a giant insurance policy, which is only a Band-Aid over the problem, we can move that taxable appreciation outside of their estate, lower their estate tax bill. And now we can discuss how do we solve the balance of this problem. So as we're increasing their legacy, increasing the net to heirs by minimizing their estate taxes, there's still going to be a need for insurance. And as Anthony mentioned, most clients don't have to pay estate taxes with what's called a zero tax plan. A zero tax plan would be starting with planning, moving taxable appreciation outside of your estate, and then whatever's left in your estate would then go to charity. What we can do is add to that plan by preserving what's going to charity and doing what is basically a wealth replacement. So if you have liquidity in the form of life insurance come into a trust, that liquidity from life insurance proceeds generally will now buy assets from the estate at the second death, flooding the estate with liquidity that can now go to a charity or private foundation that the client has set up during his or her lifetime. So therefore, there's zero estate taxes. A charity can be funded, and now those hard assets that might be business or real estate interests that you didn't want to liquidate at the second death can now be moved into the trust. From that, and also what we can do in the balance, if you did do a private sale to an intentionally defective grantor trust, you can repay that note at death. So the plan becomes self-completing. So how do we do that? We need some insurance. So if we're going to look at insurance options, what you always want to do is start with, traditional insurance. If we're looking at the cheapest form of permanent insurance, often that's going to be a second to die guaranteed universal life policy. So no cash value, just guaranteed death benefit. The client could pay, say, $573,000 a year. Each year, we usually cut it off at age 85. You could extend this to age 100, age 120. The cost is going to be roughly the same over the lifetime. We're looking at $15 million for a $50 million guaranteed death benefit, no cash. And that's perfectly acceptable. If the client wants to go in a traditional direction for his or her insurance, that's fine. However, if the client understands leverage, wants to take on some risk, and with the advantages of potentially saving on the cost of that insurance acquisition and having a growing death benefit that can keep pace with the inflation of his assets or estate tax, we can also look at the option of financing a cash value portfolio of insurance to provide, again, a similar or greater death benefit for a lower cost. On the right side of the page, this will be a comparison to our finance plan, and we're going to blow this out in a second on the next page. But this would be comparing expenses to the benefits, net of the policy loans or premium loans that we borrowed. We're going to spend $9.2 million. So over the client's lifetime, we're saving $6 million in expense for the insurance. Here is our cash value net of the loan. Because you have a loan early on, obviously you're going to have a negative position of your cash value. And then once the cash value grows over and above the loan principal, you have a positive position in cash value. And then here is your death benefit. You're going to start generally in most designs a little higher, with the idea that if you're going to use, say, cash value to pay off the loan down the road, your death benefit is going to reduce, obviously. And then we would want it to grow from there to keep pace with the inflation as they approach life expectancy, age 85, 90, and beyond. So you're through the process. You presented the concept to the client. The client says, seems to make sense. How does this work? What are the details? When we look at that from a high level, there's plenty of designs. Again, it depends on the age of the client, the underwriting, what the financials look like. For this particular case, what we're looking at is building a portfolio of insurance. Oftentimes we see the mistake of just issuing one policy. When you're looking at, say, 50 million, 75 million, $100 million of total insurance, you're going to be over and above the retention limits at most carriers, the auto binds. So that would be one, but you also want to diversify across products and carriers to mitigate risk against a carrier having a poor product later on, a poor performance later on down the road, selling to a large company going out of business. And there's also the ability to blend, say, different products. The most popular products to finance are going to be whole life and index universal life. Over a 7 to 10 year time frame is generally the premium period that people borrow. In this case, we're going to borrow $6.7 million a year, each year for 10 years. The client's going to borrow $72 million. The client's financials need to justify that amount. What we're going to do is build a trust for the client. The trust has a separate tax ID, and the trust will be the borrower. That's important for the client to understand. And they're generally comfortable with that because it's not tying up the personal credit or, say, business credit of the client. We're making a loan to the trust that is a separate tax ID. Depending on the lender you go to, when we borrow this amount of money, on the private banking side, with some of the bigger lenders, usually the personal guarantee is non-existent. As you start going down the chain to smaller premiums, and depending on the banks and their lending terms, there might be a limited guarantee, or in certain cases, a full personal guarantee. For this size, however, obviously, we want to make sure that the client's personal assets are protected. So there was no personal guarantee on this transaction. It's fully collateralized by the cash value of the policies, as well as gap collateral, which we'll get to in 1 second. So the way we think about this is assets, liabilities, and this would be the net equity of the trust position. Net cash value, pretty simple formula here. You would take the outstanding loan minus the cash value. That is the difference that the client needs to pledge to fully collateralize the loan that the bank is making. Naturally, if you're working with policies that have surrender charges that take time to build up over time, you're going to have a negative position on cash value, then a positive position down the road based on expectations of loan rates and the policy crediting. Death benefit as well. Net death benefit is going to be the gross death benefit of your policies. And then you would assume that if death were to occur, obviously the loan is repaid first, and then the trust would receive the net death benefit net of loan repayment. Again, this is the right side of the previous page. So the interest expense for this transaction is projected to be $9.2 million. And then our risk from the client's own assets would be $6.2 million. The client, again, had liquid assets in the form of investments that we can move over to a private bank. This is cumulative, not an annual increase. So the peak collateral in this case on a cash basis would be about $6.2 million. If they were to pledge, say, securities, because of the advance rates, perhaps 70% in this case, then you're looking at somewhere between 9 to 10 million of assets that are moved to the private bank. They're making interest to the private bank, and then we're going to pay off the loan in this projection in year 16 using the cash value of the policies. You're going to take a withdrawal to basis, and then perhaps a policy loan. You want to keep that policy loan minimal. The loan is paid off in full, and now the policies are fully unencumbered, netting out to what our target was, approximately $50 million at the time of loan payoff, growing from there, and that would be that summary at age 90. So we're looking at a projection of $65 million of death benefit, $45 million of cash. You're going to notice that the IRRs are slightly higher than a traditional policy. It should be no surprise. We're using leverage rather than paying, say, $6.7 million out of pocket. The client is paying the interest on those loans. And then, as always, you want to make sure that you have a valid comparison to the traditional form of insurance. It's extremely complicated. However, the client could always go back. If he doesn't like the risk, doesn't understand the concept, we could look at a traditional form of insurance, and that, because you're removing risk off the table, that comes at an expense. you'd pay $6 million more over your lifetime. Or on a present value basis, about $2 million in today's dollars for the same amount of death benefit. Another application for life insurance would be the form of buy-sell insurance. Some people will often just position term insurance, which is a temporary band-aid on buy-sell need. However, as we see the baby boomers and millennials and Gen Xers kind of transition over time, we're seeing current business owners kind of moving away from dying with the business in their name. We're seeing a lot of people wanting to retire between 60 and 70 and be bought out of firm cash flow, have younger guys buy them out. Maybe it's an ESOP, something like that. For professional firms, however, oftentimes we see this problem of an unfunded pension plan, unfunded buy-sell. You're going to have, say, 6 partners at a law firm or engineering firm. In this particular case, we were looking at the key 6 partners, ranging from mid-40s to early 50s, different underwriting offers, salaries between, say, $150,000 and the senior partners making over $400,000. They're all going to retire about the same age. And now what we're looking to do is see, can we fund not only the exposures that they have in the event of death, a premature death of one of the business owners, if they were going to retire, can we provide a retirement benefit? And generally for professional firms, that is a deferred compensation buyout. The reason being is that for professional firms, oftentimes the value of their equity in the business is zero. Sometimes it's based on their capital account that they bought in maybe 15, 20 years ago, plus a portion of receivables. One partner might be bringing in, say, $4 million of revenue a year. Another partner might be bringing in $500,000. However, when they retire or in the event of death, if they're going to be bought out, the value of their receivables is often zero for buy-sell purposes for professional firms, since it's not a manufacturing company or construction company with hard assets or real estate, something like that. So you can build a retirement plan or a deferred compensation buyout. And whether it's buy, sell, or deferred compensation, you want to make sure that you're explaining to the client what that liability looks like. If we were to assume that everybody died day one, there's a $3.2 million liability that would have to be paid out to their families for the perceived equity value of each of the partners. For the same, in the same mindset as showing, say, traditional insurance versus premium finance insurance for estate planning, what you can do for retirement for executives or buy-sell for executives, you can compare the cost of traditional options, right? Oftentimes for professional firms, what they're going to do is have a sinking fund or pay out of cash flow. So that's option one, pay out of cash flow. The next option is to say have a conservative investment over time. And we're going to evaluate saying if we were going to buy out all these partners, they're all going to retire at the same time in year 16, and you're going to provide them with $425,000 a year as the next junior tranche takes over. Well, what you could do is start a sinking fund. So take a little off the table each year. Let's say they invest $500,000 a year over 7 years. If you invest at $3.5 million at a conservative growth rate, 4% net of fees and taxes, well, that would provide $8.5 million, and that's perfectly fine. However, you don't have any insurance coverage. So while you will have the cash flow later on down the road, in the event someone dies prematurely, you now have that benefit liability exposure. What you could also do is just do traditional insurance as well. That's perfectly fine. And if we, say, used whole life, which would approximate, say, a sinking fund of around 4% over the long term plus insurance, we could generate the same benefit while covering the discounted liability in the event of premature death. So again, $3.5 million expense. It's going to provide $8.5 million of projected income out of the policy, as well as death benefit now. So we're getting better. However, what we could do is stretch out those payments with a premium finance plan. What you can do is aggregate the financials of the individuals, as well as underwrite the business financials. And rather than borrowing, say, $1 million plus or $6 million on one insured, we're actually going to roll in, say, $150,000 policy on, or $200,000 policy on 6 insureds for an aggregate loan, aggregate premium of $1 million, right? So this is aggregate funded deferred compensation or aggregate funded buy-sell insurance with 6 different policies, and we're going to borrow from a bank in order to pay the policies each year. Similar thing we just saw. We're borrowing from a bank. We're going to repay the bank using cash value of the policy portfolio in year 16 in this case. Typically, what you're going to do is set up, say, a special purpose LLC or a rabbi trust to own the policies. We're going to borrow $1 million a year, each year for 10 years. The client is going to make a $163,000 payment. So he's going to pay over and above the interest. That should be especially true for buy, sell, and deferred compensation cases. You want the business to have a little bit more skin in the game to make sure that, one, a death benefit is there in the event of premature death, and that if you're going to eventually take income out of the policy, you're going to pay down some of that loan as time goes on. So they're going to stretch out $163,000 a year, pay over and above the interest payment early on down the road. Total expense is projected at $2.4 million versus, say, $3.5 million for a sinking fund or, say, traditional whole life, something like that. And then we can potentially generate $8.5 million. You should only be taking money out of a policy once that loan is free and clear. So you want to satisfy the bank loan, pay that off. Now your policies are unencumbered. They're no longer collateralized. Any cash value remaining is now accessible for income purposes for, again, buying out equity from a partner, from a retiring or deceased partner, or providing an income stream down the road. There's many different applications. There's many different variations in terms of estate planning for generation 1, generation 2, as well as buy, sell, and deferred compensation. The point is that when we're taking on risk, we need to identify in a historical context where that's going to make sense. Whether it's premium financing or real estate or investing on margin, we're borrowing short and investing long. Life insurance is a long-term plan. And if you're using whole life, you're going to expect the internal rate of return based on current projections to be somewhere between 4 to 5%. Maybe index universal life could potentially outperform that over time between, say, 6 and 7%. If we look over the last 70 years, we're looking at the crediting rate or arbitrage between the crediting rate of the policies and the historical borrowing rates generally being positive. It's not always true. It could be upside down. We're definitely in a rising interest rate environment. And as Anthony Martinelli said, what you want to do is make sure that you're stress testing the policies. So you want to take interest rates up high. You want to take the crediting of your policies down low, and see where the policy falls apart. Look at that cost and look at that expense in order to exit the loan properly versus the cost of traditional insurance. If there isn't a great enough delta based on the insured's age, health, or financials, and perhaps it doesn't make sense for that client. This is why this is for high net worth clients only, not clients who, in a time of crunch between, say, these periods and potentially over the next couple of years, couldn't afford to pay more in interest, pay down some loan principal, or have the ability to pay off the loan early on if things aren't going in a positive direction. When we look, however, at different products, again, the 2 most popular products are going to be a whole life policy, and that's generally going to be a limited pay whole life policy. You don't want to do this with a full pay product. Banks aren't going to commit to paying premiums for the next 40 years. Generally, that time frame is between 7 and 10 years, where the bank is going to underwrite the full facility over a 7 or 10-year time period. Whole life is one of the most popular products, as well as index universal life. When we look at why these products work the way they do, it's because of the consistent returns and the stability of the guarantees for the floor. Many years ago, they used to use variable life insurance, and banks used to finance variable life insurance. After 2001, dot-com crisis, in 2008, the global financial crisis, banks no longer lend to variable life insurance policies because when the market drops, say 20 or 40%, you're going to have massive collateral calls. The benefit of using whole life and index universal life is that when the market takes a nosedive, you have that floor stability of, say, the whole life cash value, which is non-correlated to short-term market fluctuations, as well as index universal life often have a floor of 0.1%. So you might not be earning anything in those contracts during a downswing. However, you do have that floor preventing being under collateralized with your cash value of your insurance policies. That's why variable life is no longer used, and these policies are far more appropriate for premium financing. Again, this is just another slide looking at the historical context of an average borrowing rate, which would be the red line at the bottom, and the crediting rate of what we're looking at is Mass Mutual and Penn Mutual in this example. IUL policies, again, those are fixed life policies, slightly different form of how they're credited. However, they all come from the same place, which is the general investment account of the insurance carriers for fixed life insurance. What we're looking for is the spread. It's not going to be a gigantic spread. Over time, it doesn't matter if it's whole life or index universal life, you're looking at the spread between historical borrowing rates and the crediting of the policies based on how we design insurance of about 2%. So over any 10, 15, or 20-year period. If a 2% spread is more than enough to cover what we're looking for in terms of reducing the expense of insurance acquisition, as well as increasing the internal rate of return on, say, cash value versus a traditionally funded plan, but especially the death benefit of a traditionally funded plan. Right now, the future premium financing, people have borrowed money in high interest rate environments, low interest rate environments. It just kind of changes who's borrowing the money. As interest rates rise, as we go for this inflation period and the Federal Reserve, attempts to get inflation under control, we're going to see a very steep yield curve. The Fed is not done raising interest rates for this year, as well as in the next year. However, what we are seeing is an inverted yield curve, and whether that starts this year, next year, early 2024, as you increase interest rates and expect the S&P 500, the economy to drop, the housing market to start drying up, you'll see the Fed creating room for it to come back down. Rates have been suppressed for way too long. I think we all agree with that. So now what we're looking at is the long-term rates. Again, and this changes daily. This is the forward curve of SOFR, which is now the replacement for LIBOR for most new premium financing loan transactions. Some other lenders also use prime minus or plus a certain bank spread. SOFR is going to be what most private banks are using as their floating index rate. Over the long term, again, you have to add the bank spread to this. So perhaps over the long term, next 10 years, we're looking between 3.75% and 4.25% as the long-term projected interest rate for private banks. However, this is a forward curve, changes on a daily basis. This will be different tomorrow. This will certainly be different in a couple of weeks at the next Fed meeting, and then in July as well, and then change again beginning of September as interest rates change. Again, can't stress this enough. This is why when you're working with premium financing cases, make sure you're working with a qualified intermediary that is stress testing the policies. The carrier is going to do its due diligence on stress testing. The bank's going to do its due diligence on the stress testing, but the client and the client's gatekeeper should be aware of what the risks are in terms of interest rates and product performance. And that's it, guys. Thank you very much. Thank you, NAIFA. Happy to take any questions.